Stephen Green is head of Greater China Research for Standard Chartered Bank. Stephen, I mean, that's a big hit for the property side of things, a big hit for the banks here. A bit of froth, I guess, from the investment last week. But is it all down to this slight nervousness creeping in when you saw that GDP number?
Yeah, I mean, it wasn't a great headline. I mean, we thought it was going to be about 9.1. When you look at the quarter-on-quarter growth, it's remaining pretty strong, 2.3 officially for quarter three.
I like the fact you used the term officially there, yes.
Well, I mean, I think the quarter three was actually slower. If you look at the PMIs, they've slowed. All the signals we're seeing from our client base in China suggest that things have just slowed down a bit in the third quarter. Investment slowed, sales have slowed a bit. Nothing disastrous, nothing resembling a hard landing. But I think it's clear that China's economy is slowing, and that's a good thing, right? I mean, inflation's coming down. The economy's slowed down.
Still above 6%, though. I mean, and the government's target is 4%, and people are saying, well, base effects are going to mean, oh, it'll come down, it'll peak in August, and everything's going to be fine.
Yeah, I mean, us economists, we called that a bit early,
yes,
admittedly.
Predicting the last 5 recessions, yes.
Yeah.
Kind of
but I think CPI now is clearly coming down, right? Oil's off, pig prices have stopped rising quite so much, the economy's slowing down, so overall price pressures are down. So I think CPI will probably be around 4.5% by December, year-on-year for CPI, and that, I think, is enough for the government to start loosening. Right,
and they're putting bullets for them, aren't they? I mean, it's not as though they can, if they see the economy weakening in front of them, they've got so many options, haven't they, to stimulate it?
Yeah, not as many options as 3 years ago. That's what worries the markets. But I think inflation's not to worry about. Local government debt is probably more or less stabilised. The banks can roll over stuff. Evergreen loans if it becomes a problem. And the biggest thing, I think, is still housing.
Yeah. Well, we saw the numbers today, and they do sort of tell us that the market is flat if you look on a quarter-on-quarter basis. I mean, you've got, I think, Shanghai house prices up 3.3% in a year. And that's, if you wanted to engineer something of a slowdown and just manage things, they're doing a pretty good job of it, at least according to the data we have.
Yeah, I mean, a lot of the developers are telling us that they're cutting prices for new projects by 10, 20%. If it's old projects, then they have to sort of give cars away and vouchers away so they don't make the previous buyers too angry. But I think generally in the first tier and second tier cities where the prices are really high, I think you're now seeing price declines. Third, fourth, fifth tier cities, prices are probably stable or up a bit, but that's less of a problem because the bubble is probably more towards the bigger cities, and there I think the government's policies are having an effect now.
Really, and but the thing is, there's a lot of inventory there as well. Now, if that suddenly comes on stream and you get real jitters, people are going to wanting to lock in the price rises they've had, and that sort of like drip drip could turn into an absolute torrent.
I mean, I think that's clearly the biggest risk facing us at the moment. The second-tier city inventory situation doesn't look good. Places like Dalian, Qingdao, I mean, there's a lot of housing stock coming online. So what I think is going to happen, you're going to see much more significant price declines in those second-tier cities, maybe even 10, 20%. But when things get too bad, you'll see the local governments coming in with supportive measures.
Right, well, property prices, property developers, I mean, you've seen them as well taking a kick in this morning. And, you know, is it warranted, really, all this? I mean, because these are hugely big moves in a single session.
Well, I mean, I think the market really just doesn't have much confidence in the government's ability to manage this soft landing. I mean, we think... I mean,
we're pricing in almost Armageddon now as far as, you know, the equity markets in China go.
Well, yeah, I mean, it looks cheap. It's certainly the bottom of the range for the last 10 years. But, I mean, there are risks out there. Europe is not solved. We don't know what's going to happen with the US next year either, so there's the exports to worry about. Real estate, I mean, I think some of the worries are exaggerated, but in the second-tier cities there is a lot of inventory. And we haven't yet seen the end of the cycle, right? We still see central government coming out and saying we have to bring prices down, we will not loosen policy. Once you see initial signs from Beijing that policy is beginning to turn, then I think the market gets a lot more reassured.
Okay, the export side of things, now that's going to be taking a bit of a hit now, isn't it? I mean, given what's happening, US has pretty weak growth. Well, Europe doesn't have any, I don't think. Well, most of it. There's some bright spots there, but generally speaking, how far does the export side of things really hit the Chinese economy? Yeah,
well, I mean, this year we think exports will provide about 1.5 percentage points of that, maybe 9.2% growth for the year. Back in 2009, they subtracted about 2 percentage points of growth. So if we get a Lehman-style event and exports decline by 20% next year, that'll take 2 percentage points away from growth. So it's important, but it's not the whole story. I mean, all eyes on this weekend, right, in Europe?
Oh, yeah. Well, you know, the Germans saying that they, well, not so sure they can do a deal. I mean, there's no surprise there, I suppose. They were being highly ambitious, given how far they'd already come. We're going to talk about that in the round table, but but your final thoughts on China here. I was talking to a property analyst earlier, suggesting, well, we do see some implosion in the property market. He's looking ahead to, well, middle of 2012 in some cities.
Yeah, I mean, when you look at those second-tier cities, it doesn't look pretty. Having said that, the Tier 1 cities, there's very little inventory in Shanghai, Beijing, Shenzhen. And when you go into the Tier 3, Tier 4 cities, there's not a lot of inventory there either. So you could have some local difficulties, I think, in China's property market.
I'm going to start off with Europe, because we talked about China. We'll come back to China, see how Europe relates. But 5 days, and Germans have gone 9. No surprise.
Well, I mean, let's see what happens at the weekend. Maybe they're trying to contain expectations a bit earlier in the week. I mean, there are obvious challenges, though. It's a big problem. Even if they manage to make the ESSF very big, there's going to be worries about sovereign ratings for Europe after that. And growth doesn't look good with most of Europe retrenching. So lots of challenges still ahead.
Let's talk about the words very big on the EFSF. So
Yeah.
BlackRock is saying 2 trillion euros is what's required. The thing we know about is 440
Surely they're just plucking
billion.
figures out the air, really, aren't they?
2 trillion is obviously a lot more than 440 billion.
Yeah.
This is the figure that right now the French banks clearly concerned from Moody's overnight about whether they can meet the stress test. If Tier 1's gone to 9%, the stress tests have not been stressed.
Yeah.
The NAV is stressed, but the tests weren't.
Yeah, they didn't test the sovereign default
and that's
rate.
absolute madness. So
Yeah.
now,
And Dexia was the 12th
Right.
or 13th most safe bank in Europe.
That was 9 almost.
Was it?
Yeah.
I thought it was 12.
they have now those figures. So BlackRock, Larry Fink saying 2 trillion euros.
Yeah, I mean, the market's looking for 1 to 2 trillion.
Right.
I mean, the problem is ECB doesn't really want to provide the leveraging facility, which the market got very excited about 2 weeks ago. So it's possible ESSF becomes an insurance firm, which would insure people on buying Italian and Spanish debt. But even then, the market's going to think, well, is there enough if you did see some serious pressures on Italy, pressures on Ireland? Is that insurance fund enough? So the danger is if we don't get the leverage, if we don't get it big enough, the market's just going to push the announcement aside and hit Italian yields
And you've
again.
also got Axel Weber, all the Germans saying ECB stop buying bonds. Now you've got overnight Christian Neuer of France saying stop buying bonds. So if we don't get a figure that's far bigger than 440 billion towards the trillions, and everyone is saying stop buying bonds, suddenly what you can do is limited, isn't it?
Yeah.
The tools you have in your box.
The Chinese aren't going to buy their bonds either.
So it just seems to be worse, Stephen, to be honest.
Well,
It just seems
yeah.
to be again a little Mr. Doom and Gloom here.
I mean, let's wait and see what we get at the weekend. I mean, the market's obviously waiting for a big bang announcement, a big solution, and the leadership in Europe must realise that, right? So let's see. China, I mean, we've seen them more active in euro. We've seen them more active buying probably mostly German bonds over the last 9 months. Looks like at the margin they've moved away from treasuries, moving towards euro. But I think China really does want a multilateral. We need a European solution. And then if the BRICS are going to get involved as well, I think China would like to be together with Brazil, perhaps Japan and Korea, together forming some kind of fund. I mean, that's not an impossibility. But first of all, I think you need a European solution to a European mess.
Well, we were talking to Andrew Ferris, who's here from BNP Paribas Wealth yesterday, and he says, I would like the market and people to quit saying that China is the global growth engine. Because, he says, if you take a look at the exports, or how much the U.S. exports to China, it's like less than 1% of GDP.
Yeah.
I mean, Europe is the same thing. He says maybe it's 2 to 3%, a little bit more. But how can we keep calling China the global growth engine when China's not buying anything for anywhere else in the world?
Apart from Australia.
Well, and then
That's iron ore.
Which
That's
is
raw
soon going to
materials.
sink into the Indian Ocean as
Which
it
eventually
sends
runs
everything
out.
into China, apparently.
well, you get sort of effects. If China's buying Brazil, China's buying Australia, you get those economies growing, which may well help America and Europe as well. But the point is well made. The West grows on China. China doesn't grow so much on the West. I mean, that's a well-made point.
Or the other way around, meaning that China grows on the West doesn't grow on China. same thing, we get it.
Same
we
thing,
get
exactly.
It. Yeah, so what does that mean for economic growth? Have you guys talked about the forecast for China going forward?
Yep, we
Is
have a
this
little
still
bit.
gonna
We've
hold over?
discussed that, but we can still go over it because
Yeah.
of Nuri Rubini's comments, of
Exactly.
course, as usual, him predicting something which is going to be doomed. So
Why did everyone look at me then? Rubini, everyone looked at me. Mr. Doom, is that okay? I should be an economist.
But what about Chinese growth? It's going to hit 8%. I mean, some are saying that that's detrimental in the future. Nice grab there with the iPad. Yeah, almost.
Rush was once great cricket. That was an example of the camera
You had
seeing
his
that
coffee
wonderful,
this
just
morning.
down the
all right.
Top slip.
I think at least in terms of China, it does look a bit dodgy, right? Clearly, you've got the real estate problems.
Is that
we
an
don't have
economics
them.
term?
Yeah, it does look dodgy. You've got the real estate sector, you've got inflation not quite gone away, you've got exports as well. But I think the key difference between China and pretty much every other country in the world today is they have a lot of policy space. They can loosen monetary policy. They can keep their exchange rate fixed. They can push on fiscal policy as well. The government is not over-indebted at the moment. So there is space to react. So I think 8% next year is easy, probably looking at somewhere above 8.5%.
Well, is this about what they talked about earlier this year in the last 5-year plan, which is qualitative growth and not quantitative growth? Or is that just a smoke and mirrors trick, basically?
No, it's not smoke and mirrors. I think the central leadership would really like to push that through. It's just very difficult implementing that at the local level. And when you have local officials who are still promoted on the basis of how much growth they've got, how much tax revenues they've got, how much investment they've promoted, it's very difficult to change their behaviour without changing the performance metrics of the local officials. And that's in the works, but it's going to take some time.
I wanted to talk about Wenzhou, if that's okay. You know that it was the only Chinese city amongst the 70 tracked that home prices declined last month. Is there a problem with Wenzhou right now? Is this just contained in the city itself, or is this, as I mentioned earlier, is this a small issue really reflective of the water issue across China?
I think it's now probably, once you've got stories of informal loans going bad in Wenzhou, I mean, we know that everyone else in China is...
shadow banking system.
Yeah, the shadow banking system. You're going to have deleveraging of the informal sector throughout the country, right? And we know that Wenzhou money doesn't just stay in Wenzhou. It's all the way up in Shanxi coal mines, down in Yunnan, water projects. It's all over the country. The big problem for us economists and for everyone is we just can't scale the problem. No one really has a good grasp of how much informal financing is out there, and no one has a clue on how bad is the situation. If it's your own money, you assume that actually you made some pretty good, you took some good collateral, and you're lending it out because you understand the risks, possibly better than the banks sometimes. But at the end of the day, we just don't know the quality of the credit decisions that are being made there.
Oh, interesting.
One thought is, again, of all the countries in Asia, I've had two answers. One was that Korea is most exposed to a Chinese slowdown, or Singapore is the exports. Which one do you think?
Very quickly, Stephen.
Yeah, very quickly. In Asia, probably you've got Australia, which is the most leveraged up, right? Everything else, Korea, Taiwan, it's all China, and also end demand in the US and Europe as well.
All right, that's quickly. Thank you, Stephen. Good to see you. Stephen Green of Standard Chartered, head of Greater China Research.